Everyone is concerned about the rising interest rates and how it's going to affect their property and themselves. The Fed have announced interest rates hikes in the last few months, and Singapore MAS have also adjusted the rates accordingly. Today, mortgage interest rates are higher than what used to be. Now, let's go back a little bit in time to see how these measures would really impact you, because the real question is whether you're going to be able to afford your property moving forward. In the past, if you have $1 million, you can go ahead to buy 10 $1 million property, because you just need to split it to 100,000 to each property, and the bank loans you 90% without any limits on second and third property. So which means that if you have $1 million, you can buy 10 $1 million properties, and if any of these properties suddenly sees an interest rate hikes and you don't have tenant, you go to an economic situation and the property devalues because some people are doing desperate sales, fire sales, you would come to a situation where the bank will do margin calls on you. And those are the kind of situations which you want to avoid. And today, if you are buying property, it's a much better environment because you have the loan to value where they only give you 75% loan today, which means you are putting 25% cash. And for subsequent properties, you only get 55% loan. So which really brings down the number of people who will go around over leveraging themselves, being very confident. Next is price volatility. Price volatility is determined by many factors in the past, and that's because you don't have seller stamp duty. You buy a property, next day you can sell. You buy a property, next month you can sell. And the other thing is, foreigners who are coming in, they may buy a property at a different exchange rate and sell at a different exchange rate just to make a quick buck here and there. This really caused a lot of price volatility, and today with the introduction of seller stamp duty and your ABSD, those things are already under control. And more importantly, we are now looking at a different interest rate regime. From SIBOR and SOAR, we have moved down to SORA. Now, what is SORA? SORA, this is quite a mouthful, so let me explain this very simply. It is basically a backward-looking, volume-weighted average rate of borrowing transactions in an unsecured overnight interbank Singapore dollar cash market. So basically, it's quite a mouthful. It means that it is doing away from a forward-looking projection to a backward-looking projection based on the averages of the past few transactions, which is a bit easier on people because it slows down the impact of any interest rates hike. And given all these factors, most people who have bought very carefully, done careful calculations with a professional, you don't really need to worry because you would have had your cash buffers to absorb this interest rate hike. Thank you. Have a great weekend.